The Bank of Canada just announced that they're going to hold the interest rate at 5%. So today I'm going to show you exactly what we know, my prediction with the market, and then how things are going to turn out, and what is actually our approach in the next 1 to 2 years. Bank of Canada has made their announcement, so today we're going to talk about what that decision was. How is this going to affect your mortgage? How is that going to affect the market? Our prediction on the next 30 to 60 days. And last thing is, I want to share with you about our approach so that you can also take that as a consideration and maybe implement it to grow your real estate portfolio. The decision that Bank of Canada has made on September 6th is that they have decided to actually hold the interest rate at 5%. Without further increasing it. This is a great news because a lot of people have been waiting for this moment because they can get a little bit break from rates not going up. And for a lot of Canadian families who are looking to upsize, downsizing, now is also finally the time where they can start making their decision. How will this affect your mortgage? If you're on fixed, you're actually okay because you're on fixed, it doesn't really change anything for you. If you're on variable and you're on static variable, you're also okay because the rate going up and down doesn't really change that much for the first 3 to 5 years. Now, if you're on the adjustable variable rates, which a lot of people actually chose adjustable rate when the interest rates started going up because they're hoping to keep it flexible. And this type of mortgage holders are actually getting the most benefit when the rates start being held or going down. And this is the audience that will have the most relief from today's announcement. Why is this going to actually affect the market? When the rates goes up, most of the buyers' confidence start going down because now they were like, okay, I don't want to be locking something in for a long period of time at a higher interest rate. If the interest rate is at 3%, all of a sudden we're locking things at 6%. It's a little hard to justify. When the confidence of the buyer start dropping, this is where the sales activities also go down. And this is usually when we see interest rate goes up, the sales will really slow down and the market start becoming a little bit stagnant. So with today's announcement, what's going to happen is that we're going to start slowly seeing the buyer's confidence going up and up. And people are going to start exploring their home options or investment options. And as they're entering into the market, what's going to happen is that people are going to start feeling like, oh my God, the market's moving again. More and more buyers are entering into the market. I need to buy soon. And as soon as we see the sales activity start going up, this is where we're seeing the real estate market start moving, which will drive the price up even more. Hey, if you enjoyed this video, make sure you like, subscribe, and for those of you who are interested in getting in touch with my team to learn how to deal source, finance of the deal, and how to get into real estate in today's market, fill out the form below. My team will actually reach out to you. So here's our prediction. In the next 30 to 60 days, we're going to see a lot of buyers that have been holding back start entering into the market. And what that means is that people who are trying to upsizing, downsizing, people who are looking for investment in the past 12 to 18 months. These people have been delaying and postponing their decision up until this point. So when the Bank of Canada says that we're holding off the interest rate, all of a sudden you push these people out of their door and start making their financial decision. And what's going to happen is that a lot of people will make assumption that this might be the rock bottom and they will not want to miss out this opportunity. Also, keep in mind, a lot of realtors who haven't been able to make a lot of sales, these people will be very motivated to encourage their buyer, their clients, to actually start transacting some real estate. So this is what we're going to see in the next 30 to 60 days is that a lot of activity is going to go up, which will really drive the price up. And what's going to happen is that the Bank of Canada might be looking at the real estate market and say, whoa, the inflation is back. We gotta maybe raise the interest rate again. My prediction on this one is that 30 to 60 days, the market will recover, but not to the point where it was extremely hot like what we saw back in early 2022. And the part that we really need to watch out is that whether or not the interest rate goes up again, because if it goes up again, it will freeze the market one more time. On the other hand, if the Bank of Canada actually decide to freeze the rate, no more rate hike, if that's their announcement, what's going to happen is that the buyer's confidence is going to continue to go up, which means the real estate market is going to grow steady moving forward going into 2024. And now there's one statistic that I want to share with you, which is the income required to buy an average home in Toronto. You need to be making about $235,000 to actually own one average home. For people in Hamilton, Burlington, it's $180,000. People in Vancouver is going to be $244,000. So the price in today's market is still going to be extremely high. And also on top of that, once you close on the property, there's going to be a tax, maintenance, insurance, and all the other stuff that you need to take into consideration. So I do not expect the housing price to go through the roof at this moment. So what does that really mean for a real estate investor like you and I? So looking at the future with such a high interest rate environment, there's only two approaches that we will consider taking. Number one is to figure out your exit strategies. And this does not mean your ability to refinance of the project. BRRRR method, in my opinion, is not working out in today's market. If you're doing a BRRRR method, you should not expect to actually pull the capital out, cover your renovation and down payment within the next 6 to 8 months. And the reason being is because the lender really tightening up their requirement for the refinancing. Number two is that what are you going to do with that money? You pull it out is 78%, depending on what type of mortgage you're choosing. If you're pulling out with a B lender, this can even be up to 8 to 9%. BRRRR method is not something that I would recommend. I would look for something that you can go in and out very quickly. If you can buy something extremely cheap and fix it up without spending too much money and sell it back to the market, which is a flipping method, that's something I would actually consider if you can actually get a really good deal. Because whatever capital that you're getting back is your true profit. Now, for some of you who are not interested in flipping or running as a business, you still want to kind of keep things a little bit more passive, the things that I would do is to buy something that may or may not cash flow too well. Have the expectation to hold for 2 to 3 years. And the reason why you want to do that is because the market right now is still pretty low compared to a couple years ago. So when you're buying here, with the interest rate dropping in the next 1 or 2 years, we can actually expect the real estate market to be accelerated again, because we talk about the market has everything to do with the buyer's confidence. So the interest rate drops, the buyer confidence will go even higher. And this is where you try to figure out how to refi or sell again. So it all just depends on your risk tolerance and what type of strategy that you actually prefer based on your current situation. If you're younger, driven, I would recommend this one. If you already have a full-time job that's keeping you very safe, do this one, but make sure that you're trying to capitalize the current market.